All right, you might already have been either familiar with this type of concepts as you see the market creating candles of this such in this market, but it might not know how it means of this such, but it might not know how it means. So today we are going to be talking about market inefficiency and market efficiency, right? So the other names for market inefficiency and the market inefficiency is also imbalance, market imbalance or imbalance, right? Balanced or imbalanced. Okay, that is basically what it means. So it has a lot of names. We have FVG, fair value gap, also. So we can call this particular area as fair value gap, as explained by the big mentors, which is ICT and other concepts that has actually named this in a different way, right, for better understanding of their clients. So what is a fair value gap? A fair value gap is basically where price creates a gap, right, to potentially come back in the future to tap into and go back to its potential direction, breaking the highs and continuing its market direction. So it is a type of order flow that basically allows the markets to leave a gap. Okay, when there are a lot of um, positions entered into the market has to practically give itself, like, I mean, some pressure to push to the upside, leaving a lot of gaps that it might not be able to fill early, then goes up, come back into the future to fill, to give we the retail traders an opportunity to take this opportunity back to its original direction if we are able to recognize this type of potentials. So um, let's look at this particular place. And a fair value gap is basically an area where market has not the wicks of each price structure has not been filled, right? So assuming we have this particular price structure, we have structure one, candle one, candle two, and then candle three. So basically what this actually behaves is that the candle wick is supposed to basically fill the middle candle, in a sense that there is no gap in between, hence the market has no reason to practically come back to that particular end to practically take liquidity or any sort before pushing back to the upside. So in this I mean, filling in a gap before it pushes. So in this particular scenario, you can see I also have the efficiency. Sorry, I think I have just switched this. This is supposed to be inefficiency, right? So this is the inefficiency and this is the efficiency. So it has been switched. Sorry for that. So now market efficiency is basically a potential place where price has actually failed, so there is no particular momentum in that particular area, hence you shouldn't be looking for price to return to those areas. Yes, price, it doesn't mean price doesn't return to those areas basically, but what it does mean is that price has no left gaps to be filled, because it probably has filled all the gaps on its way when it was going to the upside. Hence when price reaches, it basically just taps into the imbalance, which is the inefficiency, before it continues to the upside. So that basically happens to every particular trend, right? So now as you can see on the price structure, we have a bearish inefficiency and we have a bullish inefficiency. I have just combined the candles to make it very simple so that you don't get confused. So you can see all of it in the same particular price structure. As you can see, price basically creates some at some point price fills the gap, and at some point price lifts the gap to potentially come back in the future to tap and continue. It is a type of order flow, as I mentioned in the first notes, in the first when I immediately started this recording. So and also we have the bearish inefficiency. Don't mind how it is being I mean, designed, but look at the concept I'm going to speak about. In a lot of in some basic market, when there's a lot of pressure on you, let's say you are selling a cosmetic shop, and there's a lot of pressure on you, and then let's say you are offloading some things and other things, and you are trying to look for other things. You pick what is already closer to you, and then you search for the rest. Sorry, you leave what is already closer to you and search for what is not closer to you. So let's say you are having or let's just take minerals for instance. There are a lot of drinks inside the fridge, and you are trying to reach for one. You have to be sure that the other ones are there. So let's say we have two particular areas. Let's say you have the first deck, second deck, and third deck. You open you open the fridge. You are standing. You see the first deck. You leave this one knowing it is already present, and then you start searching for the other one to see if it is also present. then you come down looking for it before you now gather all of it, put it inside your basket, and practically moving, right? So that's basically just a simple explanation I'm going trying to use. But in the forex market, so what practically happens is that the big banks has a lot of what do you call it, they have a lot of money that they basically trade. Hence, when they put monies into their into a trade, practically a position, price pushes higher because that money is able to manipulate the market into pushing it and leaving practically others, other orders which is already left behind, probably limit orders that are already here. So it pushes the market away. Anytime they are placing trades, you see price pushing to the upside, creating higher highs and higher lows. After the market has relaxed, the moment they start closing their trades, you start to see a slow momentum into the market. Or the moment they start adding more position, start to come back to fill in the rest and go back to the upside. So that is the composite man and his structural behaviors. So the market inefficiency, as explained, it can be called imbalance, can be called in FVG, which is fair value gap, the full meaning of FVG. So others call it names that they think they can be able to recognize it very easily, but I would say inefficiency and efficiency is the simplest way basically I use, or imbalance is always the simplest way. You can always use, you can use anything that can basically describe what to mean in that particular situation right here. So now you know what an imbalance is, and you know what a balanced situation is. So now we have, let's look at practical examples. So when you come to this particular situation here, you can see with this candle we have a lot of imbalance created at this point, right? You can see this candle is created with a lot of imbalance. We have an imbalance here and you have an imbalance here. Hence this place becomes an imbalance or a fair value gap. You have an imbalance within these areas. So now look at this whole place is the imbalance. This whole place is the imbalance. Now you have other areas that has been filled already. So you have this imbalance too was filled by this particular area. Let's pick blue. So it was filled by this particular area, and this one too was filled. This one too is not filled yet, but we are now waiting for price to fill these areas for us. Hence I practically had the charts being reversed so that I can show you. Let's climb back to the upside. All right. Price is pretty much slower than I thought. Okay. So we have price practically filling back. You see, price was shooting to the downside, break a lot of lows, practically switching. Should I say bearish, right? That's switching bearish, as we all can see. Break of structure, and it had another break of structure from here. So it practically switched bearish, right? But because it has already left gaps in the market, it has to come back and fill those gaps to make sure it doesn't leave anything. So when price goes up, it comes back to fill gaps into the market. So we have a lot of areas where price hasn't filled. So you see price left the gap, came back and filled that particular gap. Let's take this, came back and filled this particular gap. You see this gap too was left, so potentially prices come back to fill it as well. Just wait, let's push price to the upside and see. So price filled this gap, continue to its potential direction, that's to the upside, right? Okay. I don't know why this is practically stopping, but yeah, so basically price has to fill those all these areas. And let's cut it back again. Let me see which year we are in. 2018, 24th January. So let's start it again. 2018, 24th January. Let's go to the weekly so that we can be able to get those type of areas. So practically we will have this all over and over again, right? So it basically doesn't matter when it is, how it is done, but what you need to know is that price would always return to is, I think, 28th August, right? Okay, so let's close this. I'll go to the one now. All right, so this is what basically happens. We have all this right here. Why is it not always continue when I go? I don't want to make this video too long. Okay, let me just use normal and go and cut it from there. Okay, send me to 2018 August 20th. Go to, let's see if it takes us to that place. All right. Oh, okay, so it created a huge gap, right? Price created a huge gap from here. I think that was the reason why it hasn't practically given us that. So after this, right, so you might not see this. All right, so now we have this particular thing going on. Now let me take the pictures of this before we continue. So now you have an idea of what I was actually explaining about. Let's have download and save it as PNG. Okay, so let's look at other areas. I think with this gap, yes, price will definitely feel it. Anywhere that price has created gaps, right, it definitely feels it. Let's put a line here, and when you reach that line, you see that price has filled that line. You can see this is the line. Let me make it bigger for you to see. Make it big one. All right, and make it something like yellowish. Okay, so when you check in the previous data, price will basically fill it. Where is, okay, the replay mode is not working, but let's get it done. Okay, so you can see price has already filled it years ago. You can see price has already come back and filled it years ago. So you can see that now that price has crossed to the upside, price has filled it years ago, and every imbalance inside the market will get filled as time goes on. So you see practically this price, a recent price action, we had imbalance here, price filled it. You see after filling, you see the rejection it made, shot to the upside, and then practically came back. And after it filled and finished, there is no imbalance here for it to fill again. So price continued back to the upside, creating other imbalance to us as well. You see we have this imbalance, we have this imbalance. So price is practically going to fill every single imbalance as time goes on. So you can see this imbalance was filled by this one before it continued push down, no imbalance to fill, it continued to the upside. So price follows imbalances to fill a particular structure. So basically when you go to the weekly time frame, you see more of these imbalances, more than you can practically expect, right? Let's clear all this. So you can see this imbalance, there was a lot of imbalance on this. When we go to the monthly time frame, right? When we go to the monthly time frame, let's go to the 1 month. When we go to the monthly time frame, you can see all this whole place was a very big imbalance, right? It was a very big imbalance, and price came back, filled that particular imbalance, and after filling, what happened? You can see price has just continued the trend to the downside after filling it, and now this imbalance is left. Hence price is trying to go back, fill this imbalance and continue down, or maybe it's going to fill this and then go back. There's no much imbalance on these areas, it is so far, so price is just going to fill the current price action, continue to the downside. That is basically what I'm seeing on this particular structure. So you can see there's other imbalances around here. Price will eventually fill it out as time goes on. Structure is structure, and price will always do it. You shall see price has filled this imbalance, and after filling this imbalance, price has seen there's no much imbalance on this particular structure here. That's why price continued to the downside, filling this particular imbalance, and now went up. This imbalance was there, filled everything, came down, and it's now going back to fill. So price will always fill imbalance. So you can see this imbalance was not filled by these two candles. You can see this candles hasn't met, so price tried its best, went back and filled all this imbalance. You can see price has filled the imbalance and there is nothing left again. So that's why price continued to the downside, then started shooting to the downside practically. And you can also see past data around 2006, price also created this particular imbalance here. So and it was filled eventually by this strong move to the downside. And yeah, so that is basically how it works, right? The imbalance is always supposed to be filled. Now you can see there is no imbalance on this one. Other places too, there's no imbalance. So anywhere there's no imbalance, price is not necessarily going to go back to that area. When it reaches that area, practically it has filled a previous imbalance before it has continued to the upside. So hope you all understand what I'm talking about when it comes to imbalance, and then balanced price structures and how it works. So in the next episode, I will be going through combining imbalance, order blocks, and then price structure to tell you how you can enter it using this particular price structure. So see you guys in my next episode.